Hi, this is Harish here with Rutvij, Mahesh, and Raghav, and we welcome you to the second episode of our podcast, The Dogs of Dalal Street, Macroeconomic Trends.
We call ourselves the Dogs because we look out for your investment efforts and we are loyal to our listeners.
And contrary to the name, which is just a nod to the Wall Street of our home country, India, we will mostly be discussing American markets on this show.
We will be your best friends when it comes to investing during a pandemic, and we're here to help you learn the basics of finance, capital markets, and applied economics. We realize that a large percentage of our viewers are people who are looking to better their understanding of financial concepts and are not financially literate themselves, so we dedicated this episode to discuss some basic macroeconomic concepts.
Alright, so let's start off with production itself. GDP is a term that you frequently hear. You may have heard politicians, economists, and financiers bring it up all the time. But do you have a practical understanding of what it really means? GDP stands for Gross Domestic Product, and it has to do with the circular flow of income. The economy is made out of numerous transactions, almost too many to count. The inner circle of this flow consists of households and firms. The households are consumers and supply money to firms in exchange for goods and services. Firms pay back households via wages and other alternative forms of payments, like dividends given back to shareholders. There are injections and withdrawals within the subsystem. A domestic withdrawal would be taxes or saving money without investing it. Withdrawals can also include things like importing goods or outsourcing work, which can lead to money being taken out of the subsystem. So, an injection is when a transaction takes place in the subsystem, i.e. a dividend or a purchase of a good. These injections grow rather linearly with productivity. Productivity is what allows the creation of technology, which furthers production frontiers. In these steady state growth conditions, inflation grows at a steady rate because there is more cash flowing, standards of living are up, and you're making more, and unemployment is low. COVID has caused stagnation in many parts of these cycles, as you can most visibly see. But back to gross domestic product. It equals consumption plus investments plus government purchases plus exports minus imports. Now you can imagine why GDP would shrink in these conditions, and you should be able to identify symptoms that lead up to it. Right, so now let's go and analyze that formula. It's consumptions plus investments plus government purchases plus exports minus imports. All right, so during COVID, we probably had to import a lot of medical supplies. At the same time, we had to export like stuff like ventilators, right? And I'd say that's like a null point if you consider it at this time and at this stage. But consumption, it's probably down because people are only buying essential goods. That's just the dynamics of a recession. Investments, well, that depends on how you look at it. I'd say institutional investments are doing pretty well right now. And that's especially because these financial institutions are looking for a safer place to put their money. And I'll discuss why they're not putting it in bonds and that type of thing later. But yeah, so and the last part of that transaction is government purchases, right? And now at this point, the government is it's not really purchasing, but it's more taking on debt and taking on like the issues.
Spending a lot on the people.
Yeah, it's spending a lot on the people.
Yeah.
So that's what's pulling our GDP up, right? Even though they're not spending on defense as they normally would, or they're not spending on Medicare. Well, they are spending on Medicare, but maybe it's not being spent on Medicare that's related to other stuff, right? So there's that, and on top of that, it's like the military spending's down. I'm pretty sure we're bringing back home a lot of troops, so that's probably hurting government spending to a degree. But you should realize that one of the things that are pulling our GDP up so much is the biggest spender in the economic cycle, which is the central bank. Everyone should realize that the biggest spender will always be the government. They're the ones who control the money supply. So yeah, make sure you pay attention to what the Fed has been doing, because that plays a big role in macroeconomic trends. So, but let's go back to GDP, right, and production. The shrinking in GDP has an adverse effect on companies that take on tons of leverage, and we'll have someone discuss leverage here later. And this is why we advised in the last episodes to not invest in heavily leveraged securities. Because as much as leverage can help you multiply your upside, it can multiply your downside by just as much. This is why in 2008, when the housing market crashed, the government had to help with the leverage that big financial institutions took on when they bought collateralized debt obligations, or CDOs. And this was called a deleveraging, when the government had to bail out these banks. And right now what we're having is a stimulus. That's slightly different. It's not exactly the same thing as a deleveraging. But Now, because of the dynamics of a recession, people are only buying these essential goods, right? So things like masks, food, and maybe Netflix subscriptions, because I guess that's essential nowadays. But they deal, and those that deal in these non-essential goods, or they deal in industries that are being shut down right now because of what's going on with COVID and economic shutdowns, which is like possibly the worst thing that you can have in a recession, right? Like at least in 2008, operations continued as normal. Like sure, yes, there was a lot less money than we realized.
Yeah, this is like a totally new scenario. So we really can't compare to previous recessions, because previous recessions we had financial reason that people are unemployed. Now it's mostly because people can't go outside. Yeah. So it's a totally different paradigm.
Exactly. And I know that macroeconomics doesn't have to do with, COVID and recessions that much, but you can't help but look at it this time. So, macroeconomics is important and the principles themselves are important. But right now we're going to do our best to link them to COVID so that you understand how recessions work and how this recession is a little bit different than ones that you may have noticed in your recent years, which like the dot-com bubble, it had to do with a bad valuation of assets. And it was the same thing in 2008. It was just, taking on tons of debt that, people couldn't pay back, the subprime mortgage crisis. But yeah, Mahesh, you were going to say something?
Yeah, so I was just wanted to bring up that the 2020 recession, or the things that we're experiencing in 2020 due to COVID-19 are, a lot different from what happened during the dot-com bubble of 2000 or in 2008, because during both of those times, what actually caused the recession is that short-term debt cycle where people... The amount of debt that's accumulating exceeds the growth of incomes, right? And so that's causing institutions to have to higher their interest rates, higher debt repayments, and take all these deflationary measures, which then inevitably lead into a recession. So, but in this case, what's causing spending to decrease isn't necessarily that increase in debt or those deflationary things that would have come after, let's say, like a huge debt burden. It's more of just they've decreased directly from the virus and the things that have happened from that virus. So there's not really that much of a debt bubble.
Yeah, but the debt bubble will increase because when you slow production down, the debt builds up, right? So that's not entirely true, because now it is a debt problem, which is what people are concerned about, that there could be a second recession immediately after because of the debt concerns, right? So yeah,
there could be another one.
Yeah. Well, it doesn't have to be a recession.
Really that.
It doesn't have to be a recession, but there could easily be a debt crisis because when you stop production, we can expect that. So, and during these cash crunches, because of something called the cash conversion cycle, these non-essential goods and providers of these, they are especially hurt if they use leverage. And this is a microeconomic principle and finance principle. So Dr. Mihir Desai, he really well described it in his book. And Dr. Desai, he's a professor teaching at Harvard right now, and he uses a great example in his book, How Finance Works. So imagine that you sell hammers to contractors, right? And you take X amount of days to pay off the supplier. The hammer sits in your shelf unsold for Y days, and you give credit to the contractor buying the hammer from you for Z days. So you need Y plus Z minus X days of funding, because you subtract the first transaction, right? Because that was a loan extended to you by the supplier. So that's the funding gap, right? Y plus Z minus X. And that's your working capital. So, so the cash conversion cycle expands, and businesses look less and less investment worthy, right? Because they need more loans now. And when those funding gaps expand, it turns into them, not making a profit. Like it adds on to that concern as well, right? Because they're already not making sales. So now it sits in the inventory a lot longer. And in 2008, this was a time of financial inefficiency and a misunderstanding of the mortgage markets that led to these institutions and individuals being invested in risky and volatile securities that were really worth far less than they were believed to be worth. And this time an external factor made everything else like much more uncertain. So yeah, I mean, just imagine this funding gap is like vastly increasing because nobody's buying the goods that you're selling. That's what's really causing a liquidity crunch, right? And that liquidity crunch will make it worse when you're taking on leverage, because now that funding gap becomes, more and more harder to fund. And obviously banks won't lend as easily, and it makes a really bad look for businesses who take on leverage. So, and we never want to count that against them, but yeah, I mean that's gonna be there because people aren't buying as much stuff. So go ahead, Raghav.
When the debt to liquidity ratio looks bad, it creates a bad image for the business, as it doesn't look as investment worthy as before because it's more likely to go bankrupt.
Exactly. Yeah. So, there is a chance that the stimulus, it grazes at least fixing the credit cycle a little bit. That's what I guess the liquidity has to do with, to some degree. But we may see unnatural inflation after this money is actually, being spent. We might not see the effects immediately for consumers. But it's quite obvious that stock prices are being artificially inflated. And a long-term consequence of this is that financial institutions across the world will not want to hold the United States dollar because they're concerned that the Fed will just print their way out of all sorts of debt. So, I mean, I guess we should take some time to explain why banks hold on to U.S. dollars so much. But basically, the U.S. has never, defaulted on any debt before. That might change. I'm not sure. But so banks consider it, like all across the world, banks consider it very safe to hold on to U.S. dollars because U.S. dollar is it's an IOU from the government, and it's a treasury bill, right? So it's always, I guess, fulfilled. The only way that it wouldn't be fulfilled is if the U.S. government were to default on its debt. So it is the most secure currency, and so I guess, I mean, if I were a bank, I would probably be concerned seeing that we're trying to print our way out of debt, and a long-term consequence of this would be that these financial institutions they might be too scared now to hold on to dollars, and the dollars may not have as much of a buying power as it did before compared to other currencies. It might not see as much, I guess, confidence in it, right? So one way to measure this is the dollar strength index, the DXY. It's starting to show weakness when you put it up against other currencies, and it weights them by like how much the currency is flowing. So that's what the DXY is. It compares the US dollar to the euro, the Swiss franc, and a bunch of other currencies, and the Swiss krona, I think. So yeah, this would put annuities like bonds at a major risk. If you understand the structuring of a bond, it's a fixed income security. So you can use an inflation index security that adjusts debt payment rates to inflation rates that are tracked by the Consumer Price Index, or CPI, and we'll have Mahesh talk about that more later. But these types of debt instruments were created so that in case the government starts printing too much to pay off debt, your bank account wouldn't be left worthless, right? Because I mean, at one point that currency, the promise, the IOU, which is a bond, it's not going to be worth anything if the government just prints its way out of it all the time. So. And the Consumer Price Index, I guess I should talk a little bit more about that. Just an introduction to it is it tracks the prices of things. It's a basket of goods, right? And the increase in the price of goods is what causes inflation by the textbook definition. So, an increased money supply can cause an increase in the price of goods. And I'll explain how that works. So now that people are making more money, there will be a higher quantity demanded, which forces a shift in the demand curve that adjusts supply curves as well. Right, and when supply curves and demand curves intersect, there can be equilibrium. But and so the Consumer Price Index itself, or CPI, it's compiled by the government as a basket of goods, and it takes their average costs in an urban environment to see how much an average person can afford. So the CPI doesn't just have essential goods; it has stuff like cigarettes too, which aren't an essential good. But it's just a weighted average of a vast variety of goods available. So yeah, and The last thing I just wanted to mention is we may not see this increase in money supply and income right now, but everything always trickles down from Wall Street to Main Street. So I just like people to remember that. You'll see inflation in stock prices, and we're seeing it in bigger assets that are more institutionally bent, I guess, like home prices. They're also inflating now. So just watch out for inflation, and I guess hold on to as much material goods as you can to hedge. Like recently we've seen silver and gold show some strength again. So yeah, I think that's my extent to what I know inflation to be, or to what I'm going to discuss it in this episode. I'll pass inflation on now to Mahesh.
Right, so we just briefly discussed about inflation and how by the textbook definition it's just due to that unbalance in the amount of spending versus the quantity of goods that are available that drives that increase in price, and that causes currency to kind of lose its value. And now you're seeing all these house prices go up, the stock market being inflated, all these things mainly because of the excessive amount of money that's being printed now. And I mean, that's not necessarily always a problem when you print money, as long as you have a decrease in credit to offset that increase in price, so that you can maintain to offset that increase in money or currency that's being put into the market, so you can offset that decrease in credit. Because often during these recessionary times, you see credit kind of just disappearing when people see their assets losing value or stuff like that. But I mean, in this case, the inflation is increasing more than what credit is decreasing at, so that's why you're seeing all these adverse effects come into play. But I can actually split this inflation into two main categories. One of them is called demand pull, and one of them is called cost push. And demand pull is what we're talking about when the demand is higher than the supply, and that causes increased prices and ultimately a decrease in currency value, right? And cost push is kind of different in that it kind of stresses how when underlying commodities, like simple things like oil or wages, stuff like that, when they start to increase, everything else that depends on those simple commodities, the prices of those also go up. And so that kind of underlyingly influences the entire economy and drives up the prices of a lot of things. So an example of demand pull would be like cuts to interest rates. So that allows people to accumulate more wealth. It encourages borrowing, and it thus increases prices because people are now able to spend more, and that decreases currency value. And so as more money goes into circulation, people are yada yada able to spend more. That person's spending is another person's income, and that leads to this pump in valuation that we're seeing right now, and that goes hand in hand with the money that's being printed. So that's the other classic example of how demand pull inflation would occur, is that increase in money supply, which historically has actually led to the downfall of many countries, where, as I mentioned before, if you don't offset that balance of credit to currency or money correctly, you'll just end up putting up so much money and not focus on other things like lowering interest rates, or maybe your interest rates are already at zero, and at that point you can't really do anything else to stimulate the economy other than, I guess, redistributing wealth.
Negative interest rates.
Yeah, like we saw with negative oil prices, stuff like that. Yeah. I guess. But we've seen this historically in countries like Venezuela and Zimbabwe. That's specifically hyperinflation. That's the type of inflation that a lot of people try to scare you about, because these inflation rates are in the millions, and especially with Venezuela, that inflation train began around 2016, and it experienced actually a 53 million % increase in the inflation rate by April.
I think we may have seen a bigger percentage change in Zimbabwe. I think this was pretty infamous when the Zimbabwe dollar got so inflated that 100 trillion Zimbabwe dollars was equal to 40 US cents. Of course, that's an extreme example, but that just shows what can happen when the government really doesn't have a basic understanding of economic concepts and when you just try to get out of a hard situation.
Yeah, exactly. Well, I'd say that the U.S. government has enough creditworthiness and an understanding of how econ works to not fully go out and nationalize the economy just to try and save whatever's left of it at this point. But and even though it's not bad to try and do a stimulus, the ramifications of it, if it's done improperly, can be a lot worse than what it was trying to fix. So I think that's what people are scared of, right? That it can make the situation even worse if there's too much debt.
Yeah.
Right. And on the cost push side that I was earlier discussing, higher wages can also play a role because, like I said, they inadvertently affect the prices of everything that comes later in the supply chain of product manufacturing. And also, if raw material prices increase, they drive up the prices of everything else which requires those basic products. And that leads to more people paying for the exact same good and leading to the devaluation of the dollar. And I think that's what actually happened in Zimbabwe. I think, if I recall correctly, there was something enacted which kind of cut down the production of goods that were created, or specifically farming. So I think the agricultural output of Zimbabwe was drastically decreased, and that actually led for the supply of things to decrease rapidly. And not only now do people have to pay higher for the same good, but I mean, it's food. It's a very basic commodity, and now that's in high demand. So that affected store prices, and now they mark up their prices extremely high just to deal with the high level of inflation that's occurring. And then the government prints out more money just to try to deal with it, but doesn't go through any of the other routes like lowering interest rates or redistributing wealth or yada yada that could be used to lower inflation. So that's when things get kind of out of hand.
Yeah, so yeah, like I said, like Zimbabwe is like the kind of worst case scenario of what can happen. Just like Mahesh said, they took like all the worst possible routes to fix the ramifications of the original inflation, which just led to more inflation, which is how they got so infamously to that $100 trillion Zimbabwe dollar bill.
And like I said, I don't, like Ruvich actually said, I don't think we'll see that kind of situation happening in the US because they're generally more accredited, and we will go through other routes other than just rapidly printing money to try to decrease inflation and try to stimulate the economy, right? Like we're seeing with lower interest rates and stuff like that. So
So I want to go back really quickly, to my point where I talked about how GDP has to do with that formula, right? One part of it was exports minus imports. So I want Raghav to sort of bring up international trade and I guess talk about the impact that has on the macroeconomic scale.
Yeah. So international trade is very important in order to understand macroeconomics, as it provides commodities to people or to entire governments that they wouldn't get in their own country. So let's start with review some basic terms. What is international trade? International trade is the exchange of goods or services across borders for money or other goods and services generally. So this is a pretty simple definition. An import is when a government brings in goods or services from another country, i.e., the United States brings money from China. An export is when a government sends goods or services to another country. For example, the United States gives other countries planes. So it is very important in international trade. A tariff. A tariff is a tax on imports on exports. The collected tax is called duty. It's usually used to boost domestic industries or as a response to growing political tensions between said countries. And exchange rate, how much a specific country's currency is worth in terms of another currency. It varies from country to country. Currency appreciation. So this is basically a reverse inflation, as Mahesh talked about. An increase in a currency's value in terms of another. Currency depreciation is first step to inflation. A decrease in a currency's value in terms of another. That means imports get more expensive. Like for example, if the U.S. currency depreciated, if the US dollar depreciated, that means imports would be getting more expensive and exports would be getting cheap. Net export. A net export is the annual difference between a country's exports and imports. So as Rutvij mentioned, the GDP formula, it was what do you call it? I can't recall. It was
Here, hold on, I'll get it for you.
Let's
Give
cut
me
this
just a
part
second.
out.
Yeah, it's consumption plus investments plus government purchases plus exports minus imports.
Yeah. So consumption plus investments plus government purchases plus exports minus imports. So exports minus imports is called a net export value. So when your net export value is bigger than your is a positive number, that means you have a trade surplus. You can trade more goods. Correct? And currently, what the United States is experiencing is a trade deficit when when a country, sorry, not a company, when a country imports more than it exports. So currently, the United States is in a trade deficit as the world's largest importer and the second largest exporter. So again, these tariffs that get put into place usually are to decrease the trade deficit between imports and exports. So why does a currency appreciate and depreciate? So when the currency appreciates, it gets cheaper for consumers to import goods, correct? While on the other hand, it gets more expensive for other countries to import goods from your country. That means the economy is getting stimulated. Your what do you call it? The money is up basically, and that's good. When a currency depreciates, it falls in value. When a currency falls in value because there's too much of it, it's called inflation. That's basic definition. Some commonly traded commodities across borders include crude oil, iron, soybeans, aluminum, silver, gold, and copper. All of these are pretty basic commodities used in manufacturing, businesses, electricity, all that. And the United States, China, Germany are the top 3 players in the world in terms of international trade of goods in US dollars. So the benefits of international trade are increased revenues, better political relationships between countries, better liquidity rates. You can obtain goods for cheaper prices than domestically made goods. For example, let's say I was buying a watch that came from China. The watch coming from China would be $10, but the watch made here would be $20. So if I bought the $10 watch from China instead of buying the $20 domestically made United States watch, I would have $10 extra to spend domestically. For example, I could go to a restaurant, I could go to a baseball game. That $10 extra would be then reshuffled into the economy. And that wouldn't have happened if I had bought the domestically made watch. So again, sometimes too much international trade can really put a strain on domestic industries, but you need to have a good balance because, okay, domestic industries are benefiting, but consumers are paying more for the same thing, basically. So I'm gonna put this out here because international trade is a very important concept in terms of macroeconomics, and a lot of macroeconomics is international trade. What would a world look like without international trade, and do you believe international trade is essential for any country's economy to run smoothly?
Yeah, so I think international trade is one of the most important aspects of any country's economic growth, because for example, your country just may not have certain resources that other countries have, right? So you may not have human labor that's cheap, you may not have glass because of the environment you live in, and you need sand to make glass. So, if there's no sand wherever you live, then you can't make glass to make buildings and windows and that type of thing. So I think for a lot of essential goods, international trade is especially helpful. I'd say the only time that I'd object against it is when it's going against national security interests, but that's a whole other issue. I think the net positives of international trade probably far outweigh. I can't imagine a world without international trade. So there's probably
delving a bit deeper into that, the history of international trade is pretty important. If we look at not ancient civilization, but maybe a few hundred years ago, we'll see that international trade was a really important piece of technological innovation. We saw all these countries exporting, importing all these different goods that were unique to only their location. We saw gold, ivory from Africa. We saw the silks and spices from Asia, tobacco, potatoes, all of these things that were unique only to one area, and they all came together to foster technological innovation, and that was only possible because of international trade. And there are even some theories because of this that a country that's completely isolated from the rest of society can't have technological innovation. And you kind of see that in the isolated tribes in the Amazon. I forgot the name of the island off the coast of India.
The North Sentinel?
North Sentinel.
Right.
Yeah, North Sentinel Island. They're completely isolated, you'd expect they'd have good growth on their own, but no, they're still tribal people because they don't have any technological innovation because they haven't been trading. They don't have the resources that everyone else does.
Yeah, I think the only time when international trade could be harmful is when countries are kind of importing way more stuff than they need to and aren't exporting or contributing to the global economy that much. In that case, that's just slowing down productivity growth, and productivity growth is like the very basic essential that you need in an economy to drive growth. So if you don't have that, you can't really expect growth in a country that's just not contributing to the economy at all and just solely relies on other countries to fuel its economy.
Exactly.
So, yeah.
And Raghav brought up a great point of currency liquidity. North Korea, if we ever trade with them, we're not going to ask for their currency because it's not worth squat in the market because there's no liquidity, right? They're not trading with anyone else. So it allows for so much stuff to be created that otherwise just would not exist within even the domestic system. A lot of the consequences of international trade, they show up in the domestic system, right? And I think it'd be difficult to imagine a day-to-day life without that. I mean, a lot of, like, for example, electronics, right? They all come from China, Taiwan, East Asia, basically, right? Japan, a lot of those places. And without them, you probably wouldn't have semiconductor chips that are as easy to access, and then computers wouldn't be easy to access, and then information technology wouldn't be widespread. And that's just one aspect, right? I mean, a lot of basic material goods that, for example, they wouldn't be in Russia because it's too cold over there, or like oil, for example, would not be in some tropical country because they're not sitting on land that has oil on it, right? And now they wouldn't be able to drive. So, yeah, I think it makes a really big difference that we come together as a world to make all of our diversity come together, right? And we each have our pros and cons, and I guess our diversity is our strength in that sense because we're able to sort of, without having to do international conquest, we can still access resources that are absolutely necessary. And I guess it makes the tapestry of the world look a lot better because I'm guessing that, international trade also encourages a lot of alliances. It encourages a lot of, cultural benefits because you need to have a lot of mutual connections and interactions to engage in beneficial mutual international trade. So I'd say like it's one of the big things that a lot of people usually just sort of gaze over, and maybe they don't look at it fully when they invest, especially.
Yeah, Rudvid, what we just talked about, that's pretty much the whole foundation of the European Union. Cutting down on tariffs, improving trade, even switching to one currency, the euro, to make trade much more easier for smaller countries like Austria, Greece, that don't really have a big say in the global marketplace.
Mm-hmm.
You mentioned like if we were to stop trading with China all of a sudden, or Taiwan, we wouldn't get all these, the computer chips or whatever that's called. So that would lead to a tremendously high price increase for those in the United States because it would be a lot harder to distribute them and make them. And when people are willing to pay a lot more for a product, that's when inflation starts happening because there's more money in the system.
Fact.
Yeah. Just because you brought up China, I'll quickly talk about that. Okay, so like, it's kind of important for the U.S. since not a lot of other countries have like the minimum wage requirements that the U.S. does, especially in like Asia, which is why a lot of U.S. companies create sweatshops, what are known as sweatshops in other countries, to outsource their labor for cheaper prices. I'm not going to go into the morality or the ethics of sweatshop labor. That can be another episode. But it's kind of really important for this industry because it helps them keep prices low because the manufacturing cost for them is also low. So sometimes switching to the country that you're located in might create an increase in prices because the cost of production might increase. But typically the opposite is true because, we get rid of transportation costs, etc.
Yeah, so I guess companies are at their liberty to evaluate whether they want to use international trade or not when it comes to their day-to-day matters in manufacturing, because sometimes it might be worth it to bring that trade international, but maybe the tariffs aren't worth it, maybe the transportation costs are not worth it, and maybe you're giving up having a connection with your home country. So that might be a problem for certain corporations. So yeah, that's why they decide to sort of keep it domestic or keep it to neighboring countries and allies only, and that's one business strategy. But yeah, I think when it comes to understanding even investment strategies, you should look at where companies have all of their headquarters at and what are the political tensions going on between these countries. That type of thing can be very important when it comes to personal investment and understanding economics. But I think we can go to Harish's now, which has to do more with when we were talking about stimulus. He's going to go more in depth to that and not just about the debt itself and the debt burden of individual companies and that type of thing. It's more about fiscal policy in general. So Harish, I'll let you take that.
Yep. So now that you guys have really learned about all the different features of the economy, we can go into what the US is doing for the current COVID lockdown. So during this lockdown, the US government has come up with a lot of fiscal policies, I think 4 so far, to help ease the economic burden on the people and thousands of small companies, and even some large companies that have lost a lot of revenue. So since a lot of people have lost their job security, demand for optional services and higher quality goods has decreased. Like optional services like haircuts, high quality goods, you might like luxury goods, services like airlines that have decreased in revenue. And obviously people would not be buying these services or goods when their jobs are at risk. They're only going to be buying the essentials, saving the money in case they lost their jobs. But lower spending does mean that companies make less money and hire less people, slowing the economic growth. This is why the government has come up with 3 fiscal policies during the COVID lockdown to ensure that the economy remains stable. I'll be talking about the 2 largest policies. So first, the US released a $483 billion Paycheck Protection Program and Healthcare Enhancement Act on April 24th of this year. And this first fiscal policy had a main emphasis on small businesses as they were hit the hardest by COVID. In addition, by giving money to the businesses instead of directly to the employees, the policy ensures that the businesses can remain operational and resume operation after the COVID lockdown ends, so that the economy is not hit too hard. The policy includes $321 billion USD in forgivable loans and guarantees to help small businesses that retain workers. The policy also includes $62 billion to provide grants and loans to assist small businesses. Besides small businesses, the policy also includes $75 billion for hospitals and $25 billion for expanding virus testing. Now, we did talk about how printing a lot of money can lead to rapid inflation and a loss of the value of currency. $483 billion, of course, is a lot for anyone. It might seem that we are heading the way to inflation, but of course, this is a really small amount compared to the annual GDP of the United States, which is around $20 trillion. So we're not going to be reaching any apocalypse level of inflation. After that, we have the $2.3 trillion Coronavirus Aid, Relief, and Economic Security Act, more commonly known as the CARES Act. So this act included $293 billion to provide one-time tax rebates to individuals, which were commonly known as the stimulus checks that everyone got. You may have even gotten it. It was $1,200 to each adult that is a permanent resident. For families, it was $2,400 with an additional $500 for each child in the family. Of course, it did go down, and richer people got much less, even no stimulus money. According to the Bureau of Economic Analysis, consumer spending is the single most important driving force in the US economy. This is because consumer spending helps companies keep prices low for their goods, but more importantly, more income means that companies innovate more, create jobs, and expand, improving the economy. So going back to the CARES Act, $268 billion was spent to expand unemployment benefits, $25 billion to provide a food safety net, $510 billion to prevent corporate bankruptcy, $349 billion in forgivable loans and guarantees to help small businesses that retain workers, $100 billion for hospitals, $150 billion in transfers to state and local governments, and around $50 billion for international assistance. So again, we see a lot of money given to corporations, small businesses, because the main goal right now is to keep them employed by the companies that they're in until the lockdown is over, so that they can keep working and the economy won't be really affected after the lockdown ends.
Right.
Compared to if they directly give money to the people, the companies are going to go bankrupt, and then after the lockdown ends, no one's got anywhere to go.
Right. Yeah, and what this is called is what you just described is sort of what stagflation is, which is it's economic stagnation, high unemployment, at the same time with high inflation. Usually inflation is it happens to decrease unemployment, right? And it has to do with, central bank policy. But what could happen possibly, and what people are concerned about, is stagflation, which hasn't happened in a while. But these types of situations, they cause a resurgence in something called Keynesian economics, which was popularized by John Maynard Keynes. And I encourage everyone to look into this because it's very, I guess, it's very applicable to what's going on now. And and I discussed how aggregate demand was decreasing, and but Keynes he said that in a market economy, aggregate demand it's very unpredictable, and during a recession and economic slowdowns, monetary policy is actually far more important, which is why what you're saying, it could have massive consequences depending on how the Fed goes and looks at what they're doing and the execution of it. It's gonna have the biggest impact after it's over. Right now, we're not still there's a lot of uncertainty, as you can tell, still with the market. There's been sell-offs and dumping, and at the same time, there'd be buy-ins because there'd be some positive news. So it relies a lot on, I guess, what people expect are gonna happen next, and we can't even be certain anymore because economists have all sorts of uncertain and all over the place predictions about what could possibly happen. So yeah, but I think that Fed policy can be extremely important, and yeah, I mean that's just I guess my 2 cents on it, that the monetary policy that they come up with here, it could lead to all sorts of undesired consequences, and I think I mentioned that earlier, that it could make things worse than what they already are right now.
Yeah. And of course, like we saw that in Zimbabwe, the government has to be really smart with how they spend their money in fiscal policy. And going back to Keynesian economic theory, like I said, these numbers do seem like a lot. We saw $2.3 trillion, $459 billion or something. $483 billion. Although this may seem excessive, especially since most of this is going to companies, people think the government isn't really helping them. But indirectly, the government is helping you. So like in Keynesian economic theory, developed by the British economist Jean Maynard Keynes, government spending on the people and the companies is the only way to fix an economic recession. This has been pretty successful during the Great Depression and the 2008 subprime mortgage crisis. So during the Great Depression, President Roosevelt created Social Security, minimum wage, a lot of other job creation programs so that more people would be employed. During the housing crisis in 2008, Obama's Economic Stimulus Act spent $224 billion in unemployment, education, and healthcare, and also $275 billion, much more, in federal contracts, loans, and grants to create jobs, and cut taxes by $288 billion. Of course, you probably want to adjust that for inflation. So, as this Keynesian model that encourages government spending during recessions has been successful during the past 2 major recessions in the past, it's only reasonable to assume that it would be able to keep the economy stable and promote economic growth after the COVID lockdown. And like we discussed before, there is a downfall to the Keynesian model. If the government starts to spend too much, spend it incorrectly, the US dollar could rapidly lose its value due to hyperinflation. However, at the current rates that we're going, I don't think we'll see that a lot. That's about it. Thank you everyone for tuning into our 2nd episode of the Dogs of the Law Street. We hope to see you again for next week when we discuss a new topic. We'll be releasing new episodes every Friday. Follow our Instagram at The Law Straight Podcast for updates and exclusive content. If you have any business comments or inquiries, please email them to thelawstraightpodcast@gmail.com. We will be putting out polls so you can vote on what you want us to discuss next, and those will be on Instagram and LinkedIn. Have a great rest of your day.